Hello friends, welcome to our channel Book Summary Do. All of you get and will keep getting similar book summaries on our channel. So friends, you must subscribe to our Book Summary Do channel and like and share this video with people. So let's move on to our new book summary today. One more request to you is that you should read this new book summary.
Investing has long been perceived as an intricate and high-stakes endeavor, where fortunes are made and lost in the blink of an eye. Many individuals enter the stock market driven by speculation, hoping to predict short-term movements and earn quick profits. However, history has shown that such speculative approaches often lead to financial ruin rather than long-term wealth creation. This is where Benjamin Graham's The Intelligent Investor serves as a guiding light. Originally published in 1949, the book has stood the test of time as one of the most influential works on investing, providing readers with practical principles for making sound financial decisions. Graham's approach is rooted in logic, discipline, and a deep understanding of a company's intrinsic value rather than following market fads or emotions. Benjamin Graham, widely regarded as the father of value investing, was an economist, professor, and professional investor who revolutionized the field of finance. His teachings have profoundly influenced countless investors, including Warren Buffett, who famously referred to The Intelligent Investor as, by far the best book on investing ever written. Unlike many books that focus on technical trading, stock predictions, or short-term market timing, Graham's work emphasizes a more measured and thoughtful approach to investing. His key argument is that investors should view stocks not as pieces of paper with fluctuating prices, but as ownership stakes in real businesses. By thoroughly analyzing a company's financial health, earnings potential, and long-term prospects, an investor can make informed decisions that lead to sustainable financial success. One of the foundational concepts Graham introduces in The Intelligent Investor is the distinction between investing and speculation. Investing, according to Graham, involves a careful analysis of a company's fundamentals, a long-term perspective, and the application of sound judgment. Speculation, on the other hand, is based on trying to outguess the market through short-term predictions, often driven by emotions such as greed and fear. Graham warns against the dangers of speculation, emphasizing that an intelligent investor must adopt a rational and disciplined mindset, focusing on value rather than trends. Another crucial principle introduced in the book is the concept of Mr. Market, a metaphorical character who represents the daily fluctuations of the stock market. Mr. Market is often irrational. Some days he is overly optimistic and sets high stock prices. On other days he is excessively pessimistic and offers stocks at a discount. Graham teaches that investors should not be swayed by these fluctuations, but should instead take advantage of Mr. Market's mood swings by buying undervalued stocks and avoiding overpriced ones. Graham also introduces the idea of the margin of safety, which suggests that investors should purchase securities at prices significantly below their intrinsic value. This ensures that even if an investor makes an error in judgment or market conditions deteriorate, there is still a cushion to absorb potential losses. This conservative and risk-averse approach is what differentiates intelligent investors from reckless speculators. In essence, The Intelligent Investor provides a roadmap for anyone looking to build wealth safely and rationally. It is not about getting rich overnight, but about cultivating patience, discipline, and a sound investment philosophy. Whether you are a novice investor or an experienced one, the book offers timeless wisdom that can help you navigate financial markets with confidence and prudence. Graham's principles continue to be relevant today, proving that intelligent investing is not about luck, but about making well-reasoned decisions based on solid financial analysis. Who is Benjamin Graham? The father of value investing. Benjamin Graham is widely recognized as the father of value investing and one of the most influential financial thinkers of the 20th century. His investment philosophies laid the foundation for modern financial analysis, risk management, and long-term investing strategies. His teachings have shaped the practices of many legendary investors, most notably Warren Buffett, who has consistently praised Graham's book The Intelligent Investor as the best guide to investing ever written. Early life and education. Benjamin Graham was born in London, England, in 1894. but his family moved to the United States when he was a young child. Despite his parents' initial financial stability, his family faced severe financial hardships after his father passed away. This experience of economic struggle profoundly influenced Graham's perspective on money, risk, and financial security. Graham's academic brilliance led him to attend Columbia University, where he excelled in mathematics, philosophy, and languages. He graduated as one of the top students in his class and received job offers from multiple industries. However, he chose to enter the world of finance, working as a Wall Street analyst. Career on Wall Street and investment philosophy. Graham began his career in the investment industry in the early 1910s, working as a financial analyst. He quickly made a name for himself by applying rigorous financial analysis to stock selection, a practice that was not common at the time. While many investors relied on speculation and market trends, Graham focused on the fundamental value of companies. Through his observations, he noticed that the stock market often mispriced stocks, sometimes drastically. He discovered that many companies were trading for far less than their actual worth, meaning investors could buy them at a discount and profit when their true value was recognized by the market. This led to the development of his famous investment strategy, value investing. Value investing is based on buying undervalued stocks that have strong fundamentals and holding them for the long term. Graham believed that an investor should always seek a margin of safety, a key principle where stocks are purchased at prices significantly below their intrinsic value. This approach minimizes risk and provides a buffer against market downturns or miscalculations. Contributions to investing and financial literature. Graham's impact on the world of investing was not limited to his personal success. He dedicated much of his career to educating others and sharing his investment principles. He became a professor at Columbia University, where he taught courses on security analysis and value investing. His teachings attracted many students, including Warren Buffett, who later built his fortune using Graham's principles. Graham also made significant contributions to financial literature. His two most influential books are Security Analysis, 1934, co-authored with David Dodd. This book introduced a detailed framework for analyzing stocks and bonds. It emphasized the importance of in-depth financial research and conservative investing. The Intelligent Investor, 1949. This book distilled Graham's investment philosophy into practical principles for everyday investors. It introduced concepts such as Mr. Market, margin of safety, and defensive versus enterprising investors. Legacy and influence. Benjamin Graham's impact on the investing world remains strong today. His principles continue to guide individual and institutional investors, helping them make rational and informed decisions rather than relying on speculation. His value investing approach has stood the test of time, proving its effectiveness across multiple market cycles. Even after his death in 1976, Graham's teachings live on, shaping modern investment strategies and serving as a foundation for financial education. His legacy is not just in the wealth he created, but in the mindset and discipline he instilled in generations of investors. Investment versus speculation. Understanding the key difference. One of the most fundamental lessons in The Intelligent Investor is the distinction between investment and speculation. Benjamin Graham emphasizes that many people enter the stock market believing they are investing when, in reality, they are engaging in speculation. Understanding the difference between the two is crucial for anyone who wants to build long-term wealth while minimizing risk. What is investing? Graham defines investing as a process that involves careful analysis, long-term planning, and a focus on intrinsic value. According to him, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. This means that an investor should conduct a detailed analysis. Before buying a stock or bond, investors should study financial statements, industry trends, management quality, and overall business stability. Prioritize safety of principal. The primary goal of investing is to preserve capital while generating steady returns. Expect reasonable returns. Investors should aim for moderate consistent growth rather than unrealistic high-risk profits. Investing is not about getting rich overnight. Instead, it involves buying undervalued assets, holding them for long periods, and allowing their value to grow over time. Successful investors make decisions based on logic, financial data, and long-term goals rather than emotions or short-term trends. What is speculation? In contrast, speculation is a high-risk approach that relies on market movements rather than intrinsic value. Speculators attempt to predict short-term price fluctuations and often make investment decisions based on rumors, emotions, or market hype rather than financial analysis. Some common speculative behaviors include market timing, trying to buy stocks at the lowest price and sell at the highest, which is nearly impossible to predict consistently. Chasing trends, buying stocks simply because they are rising in price without understanding the underlying business. Short-term trading, frequently buying and selling stocks in an attempt to make quick profits. Investing based on hype, purchasing assets based on news headlines, social media trends, or speculative recommendations rather than solid financial analysis. Speculation can sometimes lead to high profits, but it is much riskier than investing. Many speculators experience significant losses because they fail to consider the fundamentals of the businesses they are trading. Graham warns that speculation often leads to financial ruin when investors get caught up in market bubbles or economic downturns. Why the distinction matters. Understanding the difference between investing and speculation helps individuals develop a disciplined approach to wealth building. Many people enter the stock market without knowing whether they are investing or speculating. They buy stocks based on excitement, hope, or greed rather than careful research, which often leads to poor financial decisions. Graham does not say that speculation is inherently bad. He acknowledges that some people may engage in it successfully. However, he strongly warns against mixing speculation with investment. Investors who speculate without realizing it expose themselves to unnecessary risk, while true investors focus on long-term stability and value. How to invest wisely. To avoid speculation and become a true investor, Graham suggests the following principles. Focus on value, not price movements. Buy stocks based on their fundamental worth rather than their recent price trends. Seek a margin of safety. Purchase stocks at a discount to their intrinsic value to reduce risk. Avoid emotional decision-making. Don't let fear or greed dictate your investment choices. Think long-term. Hold investments for years, allowing their true value to be realized over time. By following these principles, investors can protect themselves from unnecessary risk and build sustainable wealth over the long run. The concept of Mr. Market. Controlling emotional investing. One of the most famous and insightful concepts introduced by Benjamin Graham in The Intelligent Investor is the idea of Mr. Market. This metaphorical character represents the stock market and its often irrational behavior. Graham uses Mr. Market to illustrate how stock prices fluctuate based on emotions such as fear and greed rather than intrinsic value. Understanding and applying the Mr. Market analogy can help investors make rational decisions, avoid emotional investing, and take advantage of market fluctuations rather than being controlled by them. Who is Mr. Market? Imagine you are a business owner, and every day a business partner named Mr. Market comes to you with an offer to either buy or sell shares of your business. Some days he is overly optimistic and offers an incredibly high price for your shares. Other days, he is extremely pessimistic and offers a price that is much lower than what the business is truly worth. The key point is that Mr. Market's moods are unpredictable and irrational. He is driven by emotions, economic news, speculation, and market trends rather than logic or fundamentals. As an investor, you are not obligated to accept Mr. Market's offers. You have the choice to either take advantage of his irrationality or ignore him altogether. If he offers a ridiculously high price, you can sell your shares for a profit. If he offers a price far below the actual value, you can buy more shares at a discount. And if his offers are neither attractive nor reasonable, you can simply ignore him and wait for a better opportunity. How Mr. Market affects investors. The biggest mistake that many investors make is letting Mr. Market's emotions influence their own decisions. When stock prices rise rapidly, people become greedy and rush to buy stocks at high valuations, thinking they will continue to rise. When prices fall sharply, fear takes over, and investors panic sell, locking in losses instead of waiting for a recovery. Graham warns that these emotional reactions are dangerous. Markets fluctuate constantly due to external factors such as economic data, interest rates, political events, and investor sentiment. However, these short-term fluctuations often have little to do with the actual value of a company. A smart investor must recognize that the stock market is unpredictable in the short term, but logical in the long run. Lessons from Mr. Market. Do not follow market hype. Just because stock prices are going up doesn't mean they will continue to rise indefinitely. Overpriced stocks often lead to bubbles, which eventually burst. Similarly, just because prices are dropping doesn't mean a company is worthless. Prices often recover over time. Take advantage of market irrationality. When stocks are undervalued due to panic selling, it may be a good opportunity to buy. When stocks are overpriced due to market euphoria, it may be wise to sell or hold back from buying. Think like a business owner. Instead of treating stocks as lottery tickets, view them as ownership stakes in real businesses. If a company is strong and fundamentally sound, short-term price movements should not worry you. Be patient and disciplined. Intelligent investing requires patience. Ignoring daily price fluctuations and focusing on long-term value is key to avoiding emotional mistakes. How to use Mr. Market to your advantage. Rather than being controlled by market emotions, investors should see Mr. Market as an opportunity provider. By staying rational and analyzing stocks based on fundamental value rather than price movements, investors can make informed decisions that lead to long-term success. In essence, the Mr. Market analogy teaches investors to remain calm, think independently, and act wisely. Those who understand this concept can avoid costly mistakes and take advantage of market opportunities to build wealth over time. The margin of safety. The key to risk management. One of the most critical principles in Benjamin Graham's The Intelligent Investor is the margin of safety. This concept is a cornerstone of value investing and serves as a protective buffer against potential losses. The margin of safety is the difference between the intrinsic value of an asset and its market price. By purchasing securities at a significant discount to their true worth, investors minimize the risk of losing money, even if their analysis is imperfect or if market conditions change unexpectedly. What is the margin of safety? Graham defines the margin of safety as the practice of buying stocks at a price significantly lower than their intrinsic value to protect against errors in judgment, market volatility, and unforeseen risks. For example, if the fair value of a stock is estimated at $100 per share, an investor following Graham's principles would only buy it at $70 or $80. This 20 to 30% discount acts as a cushion, reducing the impact of any mistakes in valuation or unexpected downturns in the market. Graham likens the margin of safety to a bridge built to handle weights far heavier than its expected load. Engineers do not design bridges to support only the exact weight they anticipate. Instead, they build them with extra strength to withstand unforeseen conditions. Similarly, investors should always leave room for error by buying assets below their intrinsic value. Why is the margin of safety important? Reduces investment risk. Even the most skilled investors can make mistakes when analyzing stocks. By purchasing undervalued stocks, investors protect themselves from potential errors in valuation. Minimizes the impact of market volatility. Stock prices fluctuate due to factors beyond an investor's control, such as economic downturns, interest rate changes, or geopolitical events. A margin of safety provides a buffer against these uncertainties. Increases the potential for higher returns. Buying a stock at a discount not only reduces risk, but also increases the likelihood of making a profit when the market corrects its mispricing. Encourages long-term thinking. Investors who focus on the margin of safety are more likely to adopt a long-term perspective rather than being swayed by short-term market fluctuations. How to determine the margin of safety? Investors can apply the margin of safety principle by following these steps. Calculate intrinsic value. The intrinsic value of a stock is determined through financial analysis, which includes evaluating earnings, assets, cash flow, and business fundamentals. Compare with market price. If a stock's intrinsic value is $100 but is trading at $70, it has a 30% margin of safety. Look for a sufficient discount. Graham suggests purchasing stocks that have a significant discount to their intrinsic value, ensuring a protective buffer. Examples of the margin of safety in action. A classic example of the margin of safety in practice is Warren Buffett's investment in the Washington Post in the 1970s. At the time, the company's stock was trading at a fraction of its real worth. Buffett recognized this undervaluation and invested heavily. Over time, as the market corrected its mistake, the stock price increased, generating significant returns. Conclusion: the timeless wisdom of the intelligent investor. Benjamin Graham's The Intelligent Investor is more than just a book on stock market strategies. It is a guide to rational, disciplined, and long-term investing. The principles outlined by Graham emphasize the importance of logic over emotion, patience over speculation, and knowledge over market noise. His investment philosophy remains relevant today, helping both novice and experienced investors navigate the uncertainties of the stock market with confidence. One of Graham's most profound lessons is the distinction between investment and speculation. Many individuals enter the market with the illusion that they are investing when, in reality, they are merely gambling on price movements. Graham's teachings encourage investors to focus on fundamentals, financial analysis, and long-term growth rather than short-term market fluctuations. The Mr. Market analogy serves as a powerful reminder that stock prices are often irrational. Market participants frequently react with extreme optimism or pessimism, creating opportunities for intelligent investors to buy undervalued stocks or sell overpriced ones. By understanding that market fluctuations are driven by emotions rather than business fundamentals, investors can make informed, logical decisions rather than falling victim to panic or greed. Another core principle of Graham's philosophy is the margin of safety. By purchasing stocks at a significant discount to their intrinsic value, investors create a protective buffer that minimizes risk and maximizes potential returns. This strategy provides resilience against economic downturns, unforeseen market events, and human miscalculations. Perhaps the most valuable lesson from The Intelligent Investor is that successful investing does not require predicting the future. It requires discipline, patience, and a focus on value. Investors who follow Graham's principles are less likely to be swayed by market trends, speculative bubbles, or short-term setbacks. Instead, they cultivate a mindset that prioritizes steady, consistent wealth building over time. Graham's ideas continue to influence some of the world's most successful investors, including Warren Buffett, who credits The Intelligent Investor as the foundation of his investment philosophy. The book serves as a timeless resource, guiding investors toward a strategy that is both practical and enduring. In conclusion, The Intelligent Investor is not just about making money, it is about protecting and growing wealth intelligently. By adhering to Graham's principles of value investing, margin of safety, and emotional discipline, investors can navigate the complexities of the stock market with confidence, ensuring long-term success and financial security.